key risks that are causing uncertainty very much so at the moment are we still need to see the confirmation of economic activity start to come through in real numbers, not just in some of the surveys that we're seeing. We still need to see what's going to happen with the US political outcome and whether or not there is going to be any sort of developments in relation to how the US is going to be able to manage its debt position for the next 10 years, not necessarily for the next 10 days. And I think that that's going to be a really important outcome for the markets. Another real risk is whether or not the Federal Reserve is going to start to taper in terms of its asset purchases. This is a quantitative easing program which is basically there to keep long-term interest rates very, very low. Now, long-term interest rates in the US is what drives the US housing market, and we've certainly seen housing in the US start to really pick up as a result of this sort of activity. But has the US actually entered into a self-sustaining growth profile, enabling the US Federal Reserve to basically start to ease off on some of the stimulus programs that they've got in place? That's going to be a key decision. Now, unfortunately, it's going to be very, very difficult for them to make that decision unless they see some real resolution happening on the fiscal front. And unfortunately, what we've just been through in terms of the US government shutdown and the problems associated with the US debt ceiling and raising that limit is the uncertainty is going to continue, and they're the factors that we're sort of focusing on very much so for the near term. I think what the market is actually pricing in at the moment is a very optimistic scenario. And that's why we're actually in the position that we're in terms of markets making new highs, and we've seen interest rates or bonds basically sell off as a result. So when we're actually anticipating what the markets are going to do in the future and how they're going to react to certain situations, we are very cognizant of the fact that the market at these sorts of levels, it does become susceptible to a downside event. And a lot of people ask me, what is going to trigger that sort of downside event? And it could be any number of things. And we just need to be cognizant of the fact that the market is very fully valued at the moment to overvalued. And we need to be able to substantiate why the market is at these levels through either earnings or economic activity starting to come through more solidly. As a result, what we're finding is that at the moment, it's the flow of money that's driving markets up on the prospect of actually trying to get a cheap or trying to get a quick return. Now, that's not a sustainable investment strategy. We do need to see some of the fundamentals start to justify these sorts of market levels. And so as a result, we are cautious in our outlook for the way that the markets are positioned at the moment. Any number of events could basically cause the markets to really come off. But one of the most important things is as you start to remove cheap money or access to cheap money in terms of some of the quantitative easing programs, as you start to remove that stimulus, then it's going to actually equalise the equation for investors. It's going to basically say, well, I'm going to borrow money, I'm going to invest that money, am I going to get my payback? And once that equation starts to actually equalise, you're essentially going to see an equalisation in the markets as well, right? So that's why we need to see some of the more fundamental base come through in markets, in company earnings, the way that revenue is being generated, all those sorts of things need to start to substantiate the way that markets are behaving at the moment. So the US political system has basically now come to an agreement that what they are going to do is essentially reopen government, and they are going to extend the debt ceiling limit, but only up to a certain point. And that point is, government is going to be funded up until the middle of January, and the debt ceiling will be covered up until probably the first week of February. All we've done is basically, all the US politicians have done is kick the can down the road. Now, there is a separate bill that was going through to actually start to say, well, we need some bipartisan type agreement. So the two political parties in the US basically getting together and working out a long-term solution to both the US budget deficit piece and the level of debt that the US actually incurs at the moment. Once we start to see machinations behind that working group starting to actually deliver results, then we'll be comfortable in the fact that we're not necessarily going to enter into the similar situation going through into January. If we don't get that, and there is absolute disparity between the way that the two US political parties are functioning at the moment. They could never be so opposed than they have been since the Civil War, potentially. So this is a situation where we're not going to see an easy outcome. There is going to be a lot of political horseplay that is going to actually eventuate over the course of the next 2 months. That's going to cause a lot of uncertainty. But from our perspective, all we've done is essentially delayed the issue that we've faced over the course of October, pushed it back into January. Now, if we don't see a whole lot of political cooperation start to happen in the US, then essentially we're going to be in exactly the same position come January, and it's going to get even worse. It's not going to get better. So they are some of the signposts that we're looking for to actually get some resolution out of this whole uncertainty that's basically plaguing markets at the moment.